All right, let's check out some personal banking here. So first of all, we have a couple of big major banks on the front here. We have Chase, Bank of America, PNC Bank. You can shop at a bank or even a credit union, whatever's easiest for you. I like credit unions, but we actually bank at Chase Bank with their online presence. So, first of all, you're going to go to a bank, and of course, you're going to open up the very simple checking account, right? Now, a checking account, you'll see on your papers something that says DDA. All that means is demand deposit account, and all that means is you're able to demand what you deposit in there easily, freely, and it has a lot of liquidity. And liquidity means how easy it is for you to access that money. Okay, checking accounts are meant for nothing else but transactions. So we don't care if it has an interest rate. It can earn interest, but we're not looking to save money there in our checking account. That's not what it's for. We're not parking money in our checking account. You should do that somewhere else. All right. So usually it requires an initial deposit. An initial deposit is your own money, which means that it's not a fee or anything like that. So usually I've seen those around $50, $10, $20. There are zero initial deposit accounts. I think Chase offers a student account, which is zero as long as you're a student. Which actually, even if beyond that, there's really hard. It's hard for them to actually keep track of. But you can get an account that has zero initial deposit. Sometimes there are checking accounts that require a minimum amount in the account. That's on average throughout a month. So if I have a $50 minimum requirement or minimum amount required, this is just, I don't know. I don't like minimum requirements because you're parking money in there for the bank to use. That's your money, and in return, usually they'll give you a little bit of an interest rate. But remember, we're not using our checking account as a savings account or any kind of investment. That's not what it's for. So avoid any checking accounts that have minimum balances. You're going to be able to find it because there's a bank on every corner, and a checking account is a checking account. It's a checking account. As long as I can have access online and do auto bill pay, and I get my checks automatically put in there, and I can access it with my debit card and a check, I'm cool with it. All right, that's all we're looking for in a checking account. You're going to hear a bunch of different types of checking accounts from different banks. The premier checking account, the you're the coolest person I've ever met checking account. Forget about all the bells and whistles and the frills. We don't care about that. We just want a place where we can put money in and take money out. That's all we're looking for in a checking account. All right, that's one of the products that they have available. All right, it's the main one. Right. So it's accessible with the debit card, ATM, check, or online transactions. Pretty simple. Next, we have the savings and money market account. Usually, this earns interest most of the time, all the time, actually, I want to say. And but the problem is the savings accounts are very small in their interest rates, and so I don't recommend savings accounts and money markets as a place to earn your retirement at, to invest in, because the interest rates are anywhere between, like, I've seen some that were 0.03% at the time when I was as a banker, and so here's not where I would want to park money for investment. This is a place where I would park money for an emergency fund, about $1,000 or at least 3 to 6 months of expenses in my account. Okay, uh, it is not as liquid as a checking account, which means I don't usually have a debit card associated with it. Although I can attach, I think that's my son if you can hear him in the background. I can attach a savings account to my debit card and access it through the ATM. Um, but I usually am not given an ATM card or debit card when I open up my savings account or my savings account. Money market accounts, on the other hand, are similar to checking accounts. In fact, they are a DDA. They're a demand deposit accounts where savings are not. The difference is a money market account, the bank is legally allowed to use that money for different things. They get a wider variety of availability with their cash. So they're able to use that to invest in things they weren't normally allowed to with checking accounts by law. So what happens is they will entice you to put money in money market accounts as opposed to savings by offering a higher interest rate. So that's why they're highly liquid, which means you're allowed to have a debit card with your money market account. They actually give you one when you open it up. You get checks for it. But it does have the same requirement as a savings account, where there's a fee incurred if you drop below a minimum requirement. Usually money markets have one, or conduct more than 6 pre-authorized transactions. Now, pre-authorized transactions are anything like an online automatic payment or an online transfer, or if you have if you tie your savings or money market account as your overdraft protection, which I don't know if I even have that in here. We should talk about it though. What an overdraft protection means is if you go under zero in your checking account, it'll pull from your savings account or money market in order to make up that difference. Usually still gives you a service fee of anywhere between $5 to $15. Some places charge 30, but it is cheaper than if you were to drop below zero in your checking account without one. That is not to be confused with an overdraft line of credit. Do not, I repeat, do not open an overdraft line of credit, also known as an odd lock. All right, it is not a good product. It is literally a credit card attached to your checking, and it comes with a high penalty and price in terms of interest rate. All right, so we do not want to use our checking or savings or money market as a credit card. In fact, if you own a credit card, rip it up. I'm with Dave Ramsey on that. All right. Next, one thing that they offer as an investment plan is a certificate of deposit at a bank. Now, a certificate of deposit at its core is literally a contract that you enter into with the bank, allowing the bank to use your money for a certain amount of time, usually between 6 months to 5 years. Some banks offer longer. I've seen 10-year terms, 15-year terms. At the bank I used to work with, I think they were around that 15-year terms and lower. And they give you a return. In return for an interest rate, you give the bank a certain amount of money. It's locked in for a certain amount of time. Okay, so you can give a bank some money. Now the thing is, I don't like certificate deposits as a form of investment because the interest rate is very, very small. Here's a quick look at some. All right. So the first one I see here is let me refresh the page, make sure I got it up to date here. So the first one I see here, CD rates for January 2019, is through Citizens. It is a 2-year minimum deposit of $5,000. I see a 15-month here. There is, actually I can make this higher. I can make the range higher. So there's a 5-year one. I apologize. At $5,000 minimum deposit, we talked about that is the minimum required to open it, but that is not a minimum balance. Okay, that's not a minimum balance that's required. Now its APY, and we'll talk about what APY versus APR means, is 3.15%. If you look at the offer details, no fees, no hassles, access starts here. Well, that's pretty impressive because usually a certificate of deposit has what's called an early withdrawal penalty, and we'll talk about that later. I only have about 7 more minutes here to use on this screen capture. I might have to do this in 2 videos, but that's okay. Here's the deal. Certificate deposits for a 5-year term is a long time to only earn 3.15%, because at 3.15%, we're only beating inflation by really modest numbers by 0.15%, because inflation is anywhere between 3 to 6%. And what inflation means, it's the purchasing power of your dollar. If I'm losing 3% every year on the purchasing power of my dollar, because that's how prices are increasing every year, and my income is not matching that, my interest rate that I'm earning is also, you'll have to subtract that from the interest rate that you're earning. So I'm earning 3.15%, which means in actuality I'm only earning 0.15%. That is not a great investment. Here's a better investment. Not quite. It's not insured. This one I'm about to talk about is not insured. And it is a mutual fund, which means it's tied to the stock market. But here is a mutual fund at 27.34% over the past year. That's how much it earned last year. And over the past 3 years, 21%. Over the past 10 years, 15.5%. Still exponentially higher, 5 times higher over 10% over 10 years. That's just after the recessionary period and a movement upward. So This is a large cap fund, mutual fund. The problem with the large cap mutual fund, it does have a high risk, so you have to be careful with that. Whereas the certificate deposits are insured by the FDIC here, the FDIC. Now, the FDIC is the Federal Deposit Insurance Company. Every bank that's not a credit unions are insured by the National Credit Union Association, and the Federal Deposit Insurance Company is the government. And what that is they're saying that if your money is deposited into an account in a bank, that money is insured up to $250,000 per signer per beneficiary. What that means is if I have $100,000 in the bank and the bank goes bankrupt or goes under, I'm guaranteed to get that $100,000 back because it is below $250,000. And even if the bank can't pay me, the government will through the Federal Deposit Insurance Company. This came about after the Great Depression when there were what's called a run on the bank, right? That happened in the Great Depression and some in 2008, 2007, because everyone went to go get their money at the same time. And if you live in a fractional reserve banking system, we'll talk about that later in economics, you're not going to get all of your money. Not everyone is allowed, or not everyone's deposit is still at the bank. They're only required, I think, in 2019, they're only required to keep 7% of every deposit. 7% of every deposit, which means if everyone at the same time went to get their money, it wouldn't be there. So the federal government stepped in and said, we're going to insure all of your money up to $250,000 per signer per beneficiary. That means this. If I had myself and Megan, I'm going to try to draw here. It's really bad. If I had myself and Megan, so Meg, ooh, that's terrible. We're not going to do that. We're going to not do that anymore. Discard. All right, let's go back over to the. If I had myself and Megan, that means I'm actually insured up to $500,000 on that deposit account, right? Because I have two signers. Now, if I added my son Harrison to that as a beneficiary, then that means I'm insured up to another $500,000 because it's per signer per beneficiary. And since there's two signers and one beneficiary, that beneficiary gets $500,000 of insurance because I have two signers on the account. Which means if I combine now the $500,000 for me and the $500,000 for the beneficiary, that account is now insured for $1 million. That sounds so confusing. I get it. If I was just a single person on the account and I had one beneficiary, then I'm only insured up to $500,000 because the one signer, which is me, is insured for $250,000 plus the beneficiary I added is also insured at $250,000. That account is now totally insured up to $500,000. So that pretty much will cover a lot of stuff. But if you're parking that kind of money in a bank, you may be doing it wrong. Although a lot of people love the security of the FDIC. All right, I got 2 minutes, so I'm going to hurry up. APR versus APY. You're going to see this on a lot of loans and bank products that offer interest rates. APY is the annual percentage yield, and you'll see that's usually a little bit higher than the annual percentage rate. Is because it takes into account compound interest that you would receive. Compound interest means this: if I have $100,000 in an account and it earns 10% a year, that means at the end of the year I should have earned what? Let's see, $10,000, right? So then I would take that $10,000, divide it by 12, and that should give me 833 or $8,333, right? A month, I want to say. Let's see, yeah, so a month, right? So that means every month, if it accrued monthly, then I'm earning 10% on the first month would be, after it accrued, $108,333. Now the 10% is on that amount, and then it keeps compounding over and over and over again. Albert Einstein once said that compound interest is the most powerful force in the world, and I believe him. Man, I believe him. All right, so I only got 30 seconds here. I'm just going to sign out. I hope you learned something. Please text, call me, email me, whatever it is, if you have any questions whatsoever on banking. Any question. If you find something that you're not familiar with at a bank, let me know. I'll help you through it. All right, thank you guys.